The casino-like future of financial derivatives. Another surprising move. On the last day before the National Day holiday in China Securities Regulatory Commission, it will be announced that the pilot work of securities companies' margin trading and short selling will be launched. Or it has been brewing for a long time and can be expected. The timing is completely contrary to the current world trend. After all, developed countries are using restrictions on short selling to cope with financial collapse. After all, as a kind of financial derivatives, after the subprime mortgage crisis exposed the fraud and destructiveness of derivatives, the bankruptcy of Lehman caused countless investors to lose all their money and exposed the nature of zero-sum game and gambling of derivatives, which almost the product has been pushed into the abyss of eternal doom. And it seems that compared to human rational needs used for hedging and pricing, it is more catering to people's greedy desires. Obviously, China's launch of margin trading and securities lending at this time inevitably raises concerns about its future role in the stock market and even the economy. Under the global financial crackdown, people often have excessive vigilance and insufficient understanding towards financial derivatives. Draw elephant excess. Specific deficiency. The crisis has fully demonstrated the double-edged sword effect of financial innovation, but in essence it is the expression of the original sin of the market economy embedded in financial activities, and it is a normal stage of the development of the market economy. The so-called original sin refers to the surplus caused by the production of market economy entities for exchange, and the surplus needs to evaporate. Firstly, the emergence of early financial derivatives such as futures, certificates of deposit, and European bonds, although either for hedging, risk avoidance, or financial regulation avoidance, was mainly due to the inability of normal investment opportunities to provide a way out for the large amount of capital accumulated by industry and commerce at that time. It was the relatively excess currency that stimulated financial speculative activities. On the other hand, the data shows that at present, percent of the global liquidity is caused by derivatives trading every day, and the scale of the global derivatives market has reached 2 times of the global GDP. Financial speculation deals for trading, further exacerbating the degree of excess, but also planting the seeds of evaporation. Because financial innovation has its special rules. When the capacity is increasing, the player's psychological fluctuations are becoming more and more intense, and it is extremely difficult to balance their grasp of risks and opportunities. Numerous lessons have proved that this cannot be solved by improving management technology. In addition, from the subprime mortgage crisis to the financial crisis, it is not only the result of regulatory indulgence or absence, but also financial derivatives. The essence of the game of beating drums and passing flowers that requires continuous takeover is determined. Financial derivatives can indeed trade, hedge, and transfer risks. But whether it's futures and options, various credit default swaps CDS, no matter how ingenious and complex the design, It can't change the fact of their zero-sum game. The problem with subprime loans is that in Europe and Asia, one is due to conservative traditional practices and the other is due to learning from mistakes. Except for a few institutions involved both domestically and internationally, the majority of transactions still occur between financial institutions in the United States. Once economic fundamentals such as real estate are reversed and transmitted to the financial market, and once there are no major players outside the financial system to pay, well, Wall Street can only digest them. More importantly, since the essence of derivatives is to evaporate for risk avoidance and regulation, it also surpasses constraints imposed by current trading methods. In fact, rather than Greenspan's neoliberalism causing investment banks to greedily and continuously amplify leverage like gamblers with leverage ratios of over times for Bear Stearns, Lehman, and Merrill Lynch, which means their liabilities per dollar of assets reach over dollar. It is more like being caught by the explosive development of global virtual financial markets. I believe that continuous innovation in financial instruments can provide conditions for creating continuous hotspots, allowing currency flows to flow continuously between various virtual financial markets without damaging the real economy. But now that the financial crisis has erupted and Wall Street is facing the return of the Keynesian ghost, the U.S. government has not only managed to Fannie Mae and American International Group have also issued a $1 billion rescue plan with twists and turns, and strengthened supervision over the only two major investment banks by incorporating them into commercial banks. Does this mean the convergence of financial leverage and growth? Judgment is absurd. From the perspective of the disposal method of non-performing assets after major evaporation, it is highly likely that the soup will change without changing the dressing, which is still the Wall Street style. Of the ultimate goal of the $1 billion rescue fund operation is to attract and leverage more private capital and social resources to join in the reconstruction of market order and confidence. This means that the problems caused by the greed of many players on Wall Street will ultimately be solved together by these players. As for the possible changes, whether it is directly controlled by the government, serving as both a judge and an athlete, or investing in private capital, investing in non-performing assets, the government's return from the front to the back means that it is difficult for the government to stand on the opposite side of private capital or market players. Mixed operation and joint cooperation may become new features of the next stage of the financial market. From the trend of mixed operation between commercial banks and investment banks, it can be seen that commercial banks have not been spared this time, with the support of investment banks and hedge funds improperly taking on the risk of excessive home buyers and the excessive debt of investment banks themselves supported by credit products. The combination of the two may lead to further deterioration of the problem. Therefore, after the dust settles, after a period of repair, commercial banks are likely to repackage and sell their investment banking business, and the investment banking model will obviously not end. However, the transparency and leverage ratio of its derivative trading, including executives, will be strictly required and restricted. In fact, entering the financial civilization, the existence and reproduction of financial innovation and financial derivatives has become an important economic approach, which undoubtedly has a gambling nature, is inherently guilty of surplus liquidation. Therefore, this requires innovation in trading methods to adapt to the development of derivatives. In fact, the financial crisis is causing the global financial market to fall into painful reflection, making the United States and other countries, including the United States, face the challenge of the Washington Consensus. Although the major countries in the world have coordinated their actions to cut interest rates and inject capital, it is not difficult to imagine that after the crisis, the opening of the financial field of all countries will be cautious and explore the development path of the virtual financial market for the battlefield. In the short term, financial civilization has stagnated, but in the long run, with the recovery of investment banks, confusion between governments and financial institutions, especially the weakening of Wall Street's financial power center, which once dominated the game rules, and a decrease in trust, the international financial derivatives market will eventually become a large casino with relatively open and fair rules, where countries or institutions gamble for high profits. The financial derivatives market is moving towards casino-like, serving as a safe screen for the virtual economy to directly affect the real economy obstacle, adjusting economic imbalances before they harm the real economy, becoming a place for excess evaporation with dissipative functions. But this is only a possible trend in the international financial market, and whether domestic derivatives in China are heading towards casinos, the key to success lies in whether, while accepting the double-edged sword effect and abstract affirmation of financial derivatives, we can leverage the advantages of latecomers, absorb and learn from them, and improve the barrier role of the virtual financial market. This first means separating rather than mixing. Of course, this is not to say that banks, securities, and insurance are completely in their respective positions and functions, but to set up firewalls to separate high-leverage off-balance sheet banking and financial derivative investment business from traditional banking business, in order to ensure the bottom line of deposit safety. In addition, a firewall is set between market failure and human greed. For example, the income of the boss is no longer just the final say decision of the market. Next, improve the order of the casino, ensure fair, just, and open trading rules and information, so that participants can be willing to gamble and admit defeat.